Ah, Tesla. It's got to be one of the most talked about, debated, and flat-out analyzed companies on the entire planet. But what's it really worth? And what are the huge bets that are going to drive its future? Well, today, we're cracking open a recent analyst report to really get under the hood, to understand the code behind Tesla's valuation, and see what it tells us about the road ahead. So, here's how we're going to tackle this. We're going to break it down into 5 key parts. We'll kick things off with some big news out of Europe. Then we'll dig into how Tesla really sees itself. After that, we'll weigh the good, the bull case, against the bad, the bear case. And finally, we'll see how the analyst puts an actual price tag on the whole thing.
All right, so our whole journey today starts with one single piece of news. It's really the spark that ignites this entire analysis.
Okay, so the catalyst for all of this is a pretty recent breakthrough. According to the report, Dutch regulators just gave the official thumbs up to Tesla's full self-driving software, or FSD as you probably know it. Now, this is a really big first for the European Union. So a software approval in one country. You might be wondering, okay, why is this such a big deal? I mean, we're talking about a car company, right? Well, the answer to that question gets right to the very heart of how a company like Tesla is actually valued.
Here's why this matters so much. The analyst points out that FSD is a massive selling point for Tesla. Think about it. Without that feature, European customers have a ton of other EV options, many at similar or even lower prices. This approval in the Netherlands is seen as the first domino to fall. It could unlock adoption across the entire EU, giving sales a serious shot in the arm.
And that FSD news? It's the perfect jumping-off point. It really takes us from thinking about Tesla as just a car manufacturer to understanding the company's much grander and way more complex vision for its future.
And this, right here, is the absolute core of the analyst's entire thesis. Tesla's stated goal isn't just to sell a bunch of electric cars, it's to pivot, to transform, and to become a company that's all about real-world artificial intelligence. So what on earth does real-world AI actually mean? Well, it's basically a 3-pronged attack. First up, perfecting that self-driving software we were just talking about. Second, using that software to launch their very own ride-hailing service, which they call Robotaxi. And third, and this is the really wild one, developing and rolling out humanoid robots known as Optimus for factories and maybe one day for all of us. Now, because of this big, ambitious strategy and where they are right now, the analyst gives Tesla something called a narrow economic moat. Just picture a castle's moat, right? It's a business term for a company's ability to fend off competitors and protect its profits long term. Narrow just means they believe this advantage is solid for at least the next 10 years.
And where does that protective moat come from? Well, it's 2 key things. First, you've got the intangible stuff, the sheer power of the Tesla brand and all of its in-house tech. And second, a major cost advantage. Because Tesla's manufacturing scale is so massive, it can simply build its cars more cheaply than the competition.
Okay, so we've laid the groundwork. Now let's look at the upside. This is the bull case. This is what happens if everything goes, really right.
The argument for being super optimistic about Tesla kind of boils down to 3 main points. 1. Tesla isn't just playing in the car industry. It has a real shot at disrupting autonomous vehicles, batteries, and robotics. 2. FSD isn't just a cool feature. It's the golden key that unlocks a super profitable Robotaxi service. And 3. That Optimus robot? It could completely change manufacturing as we know it and create just an insane amount of value. But, of course, it's not all sunshine and roses. There are some major hurdles here. So let's flip the coin, put on our skeptical hats for a minute, and look at the bear case. The arguments against all that optimism are just as strong. First, competition is absolutely brutal. Everyone from the old-school car giants to brand-new startups is pouring billions into EVs, which could easily force Tesla to cut prices and squeeze their profits. Second, all that money being spent on self-driving, it's a massive gamble that might just not pay off, especially when you've got competitors like Waymo who already have Robotaxi services on the road. And third, the report does note that the CEO's political activities could end up turning off potential customers. So, you've got the super optimistic bulls on one side and the really cautious bears on the other. How does an analyst even begin to weigh all these different factors to put an actual price tag on the company? Well, let's get to the verdict. After all of that analysis, all the pros, all the cons, the number they land on is $400. That is the analyst's fair value estimate for one single share of Tesla stock. So how does that number stack up against the actual stock price? Well, with a recent price of about $349, it's trading just a little bit below that $400 estimate, and that's what leads the analyst to call the stock fairly valued. Okay, this is the crucial part. Where does that $400 number even come from? This breakdown tells the entire story. The core auto business, the actual cars they sell right now, that only makes up about a third of the total value. The rest of it, a whopping $270, is based entirely on those future bets: the Robotaxi, the FSD software, and the Optimus robot.
I mean, the analyst just comes right out and says it plainly. The majority of our valuation comes from Tesla's AI software and robotics ventures. That sentence, right there, is the whole story. This valuation is a bet on the future, not just on the present.
And just to put all of this into perspective, let's see how Tesla stacks up against some rivals. Compared to other EV players like BYD and Rivian, who the analyst gives no moat to, Tesla's narrow moat really stands out. But take a look at Alphabet, the parent company of Waymo. They get a wide moat rating, which is just a great reminder of the intense competition Tesla is facing in that AI space.
But, and this is a really big but, with these huge bets comes huge risk. So the analyst assigns Tesla a very high uncertainty rating. Now, that's not a judgment on the company. It's more of a statement that the future could play out in some radically different ways.
And just how wide is that range of outcomes? Whoa, they are not kidding. In a best-case scenario where all the AI bets pay off big time, the analyst sees the stock hitting $700. But in a downside scenario where they fail and Tesla is just another car company, that valuation completely craters to $100. That is a massive gap, and it perfectly captures the high-stakes game that Tesla is playing.
Which leaves us with the ultimate question that this entire analysis really revolves around. Based on how it's valued, is Tesla a car company with a very, very expensive tech hobby, or is it really a budding AI and robotics company that just happens to make cars to fund its real mission? The answer to that question is what's going to determine whether the bulls or the bears are ultimately right.